Welcome to class 12 accountancy class. Today we will be discussing about reconstitution of partnership, change in profit sharing ratio, which is given in chapter 3. So before we go in detail, let's know the meaning of reconstitution. This reconstitution, meaning of reconstitution, as we have discussed in chapter 2, we have learned already that partnership comes into existence with the agreement of all the partners. So, in the process of running a partnership, reconstitutions takes place. So, reconstitution means change in the existing agreement where the new agreement comes into play and the existing, that is old ones, comes to an end. But the partnership firm still continues carrying on their business activities. So this is an internal arrangement where the old agreement comes to an end and the new agreement comes into existence. But the firm continues. This is the meaning of reconstitutions. But the problem arises, when do these reconstitutions take place? How? How do these reconstitutions take place? Let's see. Number one is change in the profit sharing ratio. When the partnership is established, there are some proportionate ratio where the partners agree to share the profits, future profits and losses in certain ratios, agreed ratios. But due to reconstitutions, they agree that this partnership, the sharing ratio of the partners has to be changed, whether it may increase or decrease. So this is one causes of the reconstitution. Next is admission of a partner. With the coming of the incoming partner, that is new partner, the reconstitution takes place. Because when the partner joins the firm, he has got some expectation that he will invest his capital and takes his share in the profit. But all partners has to give certain portion of their shares to the incoming partner, that is the new partner. So with the admission of the new partner, reconstitution also takes place. Next is retirement. Retirement of a partner. So when the retirement of a partner takes place, there will be a partner who wants to leave the partnership. So there may be some profit and losses or assets and liabilities lying within the partnership where the outgoing partner is entitled to get his share, because the profits or losses incurred must be earned or suffered when he was existing in the partnership firm. So when he leaves the partnership, he has to take his share and go. But the problem arises, the all profit sharing ratio has to undergo certain changes, because the retiring partner no longer exists and the new partner, the existing partner, all partners, has to decide in what ratio that their profit and losses has to be distributed among themselves. So under reconstitution, with the retirement, the reconstitution of partnership also takes place. Next is we have death of a partner. So when the partner dies, if the partner dies, like in the case of retiring partner, he also has to take his share, because there may be some profit and losses or reserves, or in other words, accumulated profit and losses that has been incurred or earned while he was alive. So when he dies, he is entitled to get his share. So with death of the partner, reconstitution also takes place. Next is we have amalgamation. Amalgamation takes place. Before that, amalgamation means clubbing of two or more business firms. So amalgamation, when the business is taken over, or when the business joins the other partner, other business firm, there should be certain changes. Reconstitution has to be undertaken, where how much share has to be owned by the parent partner or to the other partner. At the same time, what should be the sharing profit? What should be the ratio for sharing the profit and losses? This has to be decided before the amalgamation takes place. So amalgamation also affects reconstitution of partnership. Next we have change in the profit sharing ratio. Change in the profit sharing ratio means there may be decrease or increase in the old ratio. It may increase with the admission of a new partner or retiring partner, or with the admission of a new partner, or it may also decrease. So the old profit sharing ratio has to be changed. We have sacrificing partners with the incoming of partners. So sacrificing partner is a partner whose share has been decreased. Whose share has been decreased with the result of change within the partnership firm. At the same time, we have sacrificing ratio. This sacrificing ratio is a ratio where the old partner sacrifices their shares with the new partner. That is, the partner who is interested in their firm and admitted. So, it is a difference between old ratio and new ratio. So, we will have to find out how much the old partner has sacrificed for the new partner. Next is we have gaining partner. Who is a gaining partner? A gaining partner is a partner whose share has been increased. Whose share has been increased with the result of change. That is, with the result of reconstitution. That means the old partner maybe, or the incoming new partner may be gaining. We never know that. At the same time, we have also gaining ratio. That is, gaining ratio is a ratio that has been agreed to gain from the other partner. So, there may be some partner who, because of the reconstitution, gain from the other partners. So, his share will be increased, not decreased. So, this is the difference between new ratio less old ratio. This is the gaining ratio. The ratio in which all the partners share the future profits and losses is known as new profit sharing ratio. As I told you in the beginning, in the meaning of reconstitution, under reconstitution, it is clearly stated that the old agreement comes an end and the new agreement comes into existence. Therefore, under change in the profit sharing ratio, under this, the new partner, the partners agree to share the future profits in a new ratio, and the old ratio is completely abandoned and it's no longer used. So this is how the change in the profit sharing ratio takes place. So under reconstitution, again, under reconstitution, there are certain practical problems in preparing accounts. There should be certain things which has to be settled before the partner retires, or the partner is dead, or before the admissions takes place. First, we have to value this goodwill. We will have to make certain adjustment to find out the value of goodwill to be given to the outgoing partner or to be brought in by the new partner. So, under this, when we make an adjustment for a goodwill, first we will have to calculate gaining ratio and sacrificing ratio. So, after we get the value of goodwill, we will have to calculate how much the gaining partner has to give to the sacrificing partner. Otherwise, no partner gives his share freely. Therefore, we will have to compensate the sacrificing partner by the gaining partner. So, compensation of this sacrificing partner has to be made equal to the goodwill value of the firm. It has to be equal. At the same time, this amount has to be credited and debited in a particular partner's account. So, in this adjustment of goodwill, this sacrificing ratio and gaining ratio has to be calculated properly. At the same time, after valuation of goodwill, we will have to revalue assets and liabilities. This assets and liabilities keeps on changing. The value of assets and liabilities keep on changing. Sometimes it may increase, sometimes it may decrease. So, when the partner retires or when the partner is admitted, we will have to revalue assets and liabilities to find out the correct value of assets and liabilities so that you get the correct profit and loss for the partnership account to be distributed among the partners of the company. I mean the partners. So before changes takes place, that is reconstitution takes place, the assets may worth maybe 5 lakhs, but on retirement it may increase or decrease. At the same time, especially the liabilities usually decreases on retiring of partners or on admission of partners. So you will have to ascertain the correct value of assets and liabilities to be paid to the outgoing partner or to be brought in by the incoming partners. Revaluation account. In order to revalue the assets and liabilities and also to record the value of goodwill, we have to prepare revaluation account. Revaluation account, the word itself clearly indicates that we are revaluing the assets and liabilities of the firm. So, this revaluation account is a nominal account, or in other words, it is a profit and loss account. Under this account, we prepare revaluation account to ascertain profit or loss. That means the firm has gained profit, earned a profit, or they have suffered a loss. We will have to ascertain under revaluation account. So, after ascertaining the profit and losses, we will have to transfer these to partners' capital account, their respective account, in their profit sharing ratio. So, this is how revaluation account is prepared. That is, format is given here. We have 4 columns, that is particulars, rupees, and debtor and debit and credit. So on the credit side, we have by increase in the value of assets. By increase in the value of assets. So on revaluation, if the assets like building, machineries, furniture and fixtures, all this has been increased, the value of increase has to be recorded on the credit side. So by increase in the value of assets means it is not only a particular assets which has been increased, but all the assets that has been increased will have to be recorded on the credit side. That is here. By decrease in the value of liabilities, if there are liabilities that has been decreased, maybe outstanding rent, creditors, debtors, all these things, if these values, the debts that is supposed to be paid to the outsiders have been decreased, the value of decrease has to be recorded here. So also there may be certain unrecorded assets. There may be some assets that has been not recorded, that has been left out. This has to be recorded on the credit side. So this, if there is a shortage on the credit side, that means the firm has incurred a loss. So this loss has to be transferred to partners' capital account in their old ratio, not in a new ratio, but in an old ratio. So on the debit side, you have to decrease in the value of assets. So just an opposite, where here we are recording only increase in the value of assets, but on the debit side we are recording the decrease in the value of assets. At the same time, to increase in the value of liabilities. If there is any increase in the value of liabilities, then it is recorded here. Then to unrecorded liabilities, if there are any unrecorded liabilities, debts, it has to be recorded on the debit side. So if there is shortage on the debit side comparing to credit side, there is a profit. So this profit is transferred to partner's capital account as usual in an old ratio and not in a new ratio. So when we look at this overall format, the income, that is the cash inflow is recorded on the credit side and outflow or losses are recorded on the debit side. So this is how this revaluation account is prepared to find out profit or losses to be distributed among the partners of the firm. There are also certain adjustments. That is adjustment of accumulated profit or losses, profit or losses, like reserve, workman's compensation fund, or maybe employees provident fund. All these are reserve, kept as a reserve. Reserve means certain portion of profit has been blown back for future use or for contingency use. So this reserve are distributed among the partners, all partners, in an old ratio when the reconstitution takes place. Adjustment of capital. Last one is we have adjustment of capital. Under this adjustment of capital, the existing partners sometimes agree that their capital has to be fixed and then it will be distributed or shared in their new ratio or brought in. Therefore, after the division of the full amount, if there are deficiency, the partner has to bring in. If there is a shortage, deficiency, the partner has to bring in cash to make up to limit. And if there is an excess, the partner has to be paid. So in this session, we have learned how the meaning of reconstitution, and also we have we came to know that how this reconstitution takes place, when or how, and also we have also learned how this change in the profit sharing ratio is calculated, and also before preparing the revaluation on retirement or admission, we will have to make certain adjustment, that is adjustment of goodwill, assets and liabilities. Then we will have to prepare revaluation accounts. At the same time, we will have to distribute the accumulated profit and losses and adjustment of capital if the partner agrees to share, have a fixed amount of capital to be bring in or to be paid within the firm. So with this, we have come to the end of this session. In the next session, we will be doing some practical problems relating to reconstitution of partnership, change in their profit sharing ratio. Thank you.